Cool. Awesome. So welcome to today's webinar. You can see the title is Diversifying Your Portfolio with ETFs. As a quick overview, building a diversified equity portfolio is one of the core principles of prudent investing. That's why I chose this topic as such. But what happens if you do not have adequate capital, or you only have a little bit of savings to start off with? So my objective today with this webinar is twofold. Number one is we're going to discuss how exchange traded funds or exchange traded products are great investments for a young investor, and the idea is to help them kickstart the investment journey, and obviously using ETFs as a base. That's on one side of the coin. The other side of the coin is obviously ETPs or exchange traded products also offer the more advanced investor the opportunity to gain exposure to sectors or market sectors that they do not have in their share portfolio. And number one, and number two is obviously to also have what I call geographical diversification by adding some offshore exposure by using ETPs. So that's my objective today with this webinar. But just to, and the main theme also is to keep it simple and short. So I'm going to kick off with a quote from Confucius. There we go. Bring my little quote in. Life is really simple, but we insist on making it complicated. So my objective today with this webinar is to explain how ETPs are very simple products, and I'm going to use a very simple analogy. So just bear with me, because I believe that, as I say, ETFs are simple to understand. So as a way of a basic introduction, let's say, for example, I'm going to use sweets, using soft sweets as an analogy. And let's say you have a son or daughter, and you give them limited pocket money, and I can keep it very simple. You just say you give them 10 Rand per month or 10 Rand per week to buy sweets and things like that. And your children's objective, your child or your boy or girl's objective is to taste as many sweets as possible. So ideally, they would like to try at least 30 different flavors. Okay, but the problem is that the sweets cost 1 Rand each. So, and obviously, based on their little 10 Rand, they have a smaller amount of money to afford to buy, only 10 sweets. So, obviously, your boy or girl is not the only one with this problem. The sweet owner, for example, sees that there's also 2 other kids that will have the same predicament. So he suggests that they pool their money together to buy the 30 sweets. He goes one step further, very clever man. He goes and slices these soft sweets into 3 pieces, so that each of the children will gain or have opportunity to taste all the sweets. So that is a very simple way of what I say is how ETFs would work. Through one share, you gain access to a basket of shares, and as I say, you're getting exposure to all those different flavors, all those different companies. Okay, I hope that makes sense to you guys. As I say, this is a very, very basic intro. So we talk about ETPs. It's an umbrella term referring to exchange traded products. Just understand that bottom line, they're passive investments, which provide the average performance of an asset class or index being tracked. So understand that they're investment vehicles. They give you direct access to a basket of shares that are traded on a stock exchange like the JSE. And you'll see in the next few slides as such, it gives you the convenience of trading like a share. Okay. So the main thing is that the ETPs, as I say, they track an index, provide direct access to a basket of securities. And again, securities is a generic term to encompass everything from shares or equities to commodities to bonds, etc. So it's another generic term there. As I said just now, the convenience of trading through one single share. The main thing here is that they are attractive as investments because of their low costs. So we talk about total expense ratio. They have very, very low total expense ratios. That's number one. And number two, also very, very importantly, they combine. I say you're getting the benefit of both worlds. You're getting the benefit of a diversified portfolio like a unit trust, but also with the tradability of a listed share. So they are bought and sold intraday as opposed to a unit trust where they They are priced at the end of the day, but ETPs are bought and sold anytime intraday at the market ruling price. Okay, so ETFs have been around the longest. The very first one was the Satrix 40, I think it was in 2000, and then the biggest one as such is the New Gold, New Gold ETF. Although it might be a ETF, it's not classified as a collective investment scheme, and we'll go into more details in the next slide. Okay, but I just understand there are subtle differences, and I'm going to go into them right now. What are the similarities and the differences between a exchange traded fund and an exchange traded note? As I say, ETP is the umbrella term that encompasses those two groups of ETPs, exchange traded products. So number one, they're both very, very similar. Okay, if you look at the two in practice, they're very similar. Both are designed to track an underlying asset. Both often have low expense ratios than actively managed unit trust funds. And thirdly, obviously, both trade on a major stock exchange like a share. So those are the similarities. Now, the difference comes in between the ETP or ETF and the ETN in the sense that a ETF holds the asset that it tracks. Okay, whereas a ETN, exchange traded note, it acts more like a bond. You can say it's a unsecured debt note, which is issued by institution. Usually, by the way, ETPs are issued by most of the time by the banks. Okay, so institution in this sense will be a bank. So ETN, more like a bond, unsecured debt note issued by institution. And the main thing you have to worry about here is that if the bank had to go into a default or something happens there, you have to look at the credit rating of the underwriter of the bank and such. That's what you have to worry about. Okay. So just understand that they do not actually hold, ETNs do not actually hold a physical, be it gold or silver, whatever the case might be, because most of them are, if I bring my cursor in here, exposed to either commodity or currency and things like that. So they're not actually hold it. They usually have exposure to the spot price, whereas an ETF, like I mentioned just now, New Gold will hold physical gold bullion. Okay. The big difference also between the two of them is that ETFs would pay a dividend because most of the time they're involved with equities, and obviously commodities and currencies do not pay any dividends. So those are the two big things you have to worry about. Okay, or discern or differentiate between the two of them. Okay, so I hope that gives you a quick overview. As I say, my objective today is to keep it very simple and just give you a quick overlay. Okay. Sorry, let me get it. There are a lot of benefits. I believe there are 9 little benefits. If you had a look at, get my next slide here. What are the benefits? Number one, I believe, is diversification. The main advantage for, as I mentioned right in the beginning, is a core principle of a prudent investor is to build up a diversified share portfolio. So ETPs offer you a wide range. You can track domestic and foreign equity indices. You can track commodity-based indices or property, or we talk about style or fundamental kind of indices. And we'll talk about these things just now in more detail when I call blending a portfolio. You can also, as an investor, as a small investor, also have access to bonds and multi-asset portfolios. So that's what I mean by diversification. In a very similar vein, we talk about asset classes. It gives you access to asset classes not previously available. And this gives the investor the opportunity to express what I call a macro view or investment view. You might have a really strong view relative to a particular sector on the market, and you can exercise that view by having a very broad exposure to that market class or that sector, that asset class. Okay. One of the other benefits I believe is very important to look at is liquidity. As I mentioned just now, you can buy and sell ETPs anytime during the day on the JSE like any other share. Okay. The idea is that there's always a willing buyer and a willing seller, and obviously it gives you that peace of mind that you can get out of the ETP at any time. And linked to that, you can also go one step further and say, okay, accessibility, how can I get exposure to ETPs? ETPs are traded on our PSG Wealth share trading account, or you can also open up what we call a PSG Wealth ETP investment plan. This is where you can use a once-off transaction or a monthly debit order. When I say once-off, it's a minimum of 1,000 Rand lump sum, and also you can set up a monthly debit order, minimum there of 300 Rand per month. And obviously the advantage taken there of Rand cost averaging over the longer term. So those are the two ways of accessing a ETP on our platform. Flexibility. PSG Wealth offers you a wide range of ETPs, and you'll see on the next slide from various different ETP providers, as I say, mostly all the banks. So you got a whole range to choose from. They're very, very cost effective. When you buy ETP, you're only paying for the exposure to a basket of shares. You know, if you had to go buy the basket yourself or the constituents of those shares, to be obviously much more expensive. So you'll have to pay the brokerage, but also the security transfer tax, which is 0.25% of the value of your whole transaction. So ETP is obviously much more cost-effective way of getting involved. Remember also, they're not actively managed. The underlying portfolio shares are not traded so regularly, and obviously they also have lower marketing, distribution, and administration expenses. So that's why I say they're very, very cost effective. They're very, very transparent. You can go onto your portfolio, or go log on and go look at what's happening with the price right now. They're updated frequently, and obviously you can see throughout the day what's happening with the price. Okay. And then price determination, as I mentioned just now, unlike collective investments like unit trusts, ETPs can be bought and sold intraday. Do not have to wait until the end of the day before knowing the price of the investment. Okay. And as I say, I believe one of the major advantages, and this is the theme of today's presentation, is it's very suitable for a do-it-yourself approach. Some other products, the pricing structure, you might want to assume a financial advisor. This is a very nice way of building up a portfolio. As I say, as a novice investor, as a stepping stone to build up a portfolio. And then we will talk about in the next few slides how we can create what I call a core and satellite approach is one way of looking at it. But it's a very suitable way for a do-it-yourself approach. Okay. So I mentioned just now about the do-it-yourself approach, or the core and satellite investing, and there's two ways to look at it. And the idea, I spoke just now about how to blend a diversified ETP portfolio. So it depends on quite a few things. This is what they call a core and satellite investment approach. It's a method of portfolio construction designed to minimize costs, number one, and number two, obviously volatility. As an investor, I think those are two very important things to look at, apart from diversification, also costs and volatility. So saying that, you also want to provide for the opportunity to outperform the broad stock market as a whole. So this is the whole idea of blending this portfolio, as I say. The core, and I'll go into more detail in the next few slides. The core, okay, in this scenario here, would consist of passive investments that track a major stock index like the top 40. Okay, and there's a lot of other call it index tracking ETPs you can use. But additional positions, these are known as satellites, are added to the portfolio in the form of actively managed investments. So it depends on who you are. As a novice investor, you'll save up until such time you've got enough to start building up. And I suggest is look at 10,000 plus. But to save up 10,000 Rand, go buy your first tranche of ETPs, and then add to that stage until such time you got 50%. Okay, and then down the line you want to add maybe more satellites, and this is where you want to go for a particular share, for example. This is if you want to have a bit of an active and a passive approach to one portfolio. So yeah, I'm tracking the market. Yeah, I'm trying to outperform the market. So the idea is that you might want to have 5 different shares, and these might be the mid caps. This might be the top 40. The next 60 companies in that list might be mid caps. You might choose 3 companies, might be mid caps, and 2 will be small caps. You want to go for growth, so you might be looking at dividends, whatever the case might be. But the idea here is that these are more actively managed, and this is a buy and hold, and this is buy and sell. Or, as I say, more actively managed in the sense that you're doing more due diligence on the on the investments. You'll see on the next slide what I mean by doing more homework on it. So the core and satellite approach provides opportunity to access the best of both worlds. Number one, as I say, better than average performance. So it depends on your investment objectives. Yeah, you want to, it's for savings, that might be objective. Complement your retirement funds, that might be longer term. So your time horizon will complement that. Also depends on your risk profile. Are you a bit more conservative? You want to preserve your capital? Are you a bit more moderate? Or are you a bit more aggressive? So these are all things that we'll talk about in the next slide. But the idea is that ultimately it's cost control, but also it creates, all comes together as a flexible package that's designed specifically to cater for your investment needs. Okay. So as I say, you might want to put in this SETX 40 here. I'm using an example, the oldest fund around. One of the funds that also come to my attention. And remember, this is not a tip or it's not advice. I also like a thing called Core Shares Top 50, where you have the top 40 plus also the top 10 mid-cap stocks. Something to look at. So different ways of constructing your portfolio. So the idea is, as I say, to blend. And we go into the next slide. Just give my little pen here. And this brings up the question, there are certain things you have to take in consideration. You know, when to effectively design and implement a core satellite portfolio, the following factors, and there's 5 things that you have to look at, or sorry, 4 things you have to look at. Bring that up quickly, hopefully. You need to determine the risk profile and the strategic asset allocation. So, you know, you want to say, okay, I'm putting all my money into my SETX 40, that might be the core. But what are the risks? And you have to take all that in consideration. The investments for the core, you know, as I say, the SETX 40 or the core shares top 50, or you can just be exposed to a certain sector, be it the index 25, have a bigger weighting in that, or you might be a total contrarian, be fully exposed to resources you anticipate it to bounce soon, where they're oversold. Technically, I'm using an example. You also need to decide the size of the core. In this example, I've tried to keep it very simple, 50% and then 50% as satellite. So the size of the core might depend. You know, you might want to have it smaller or bigger. So the size of the core versus each of the satellites as in asset classes, and how many active satellites are you going to be using? So, you know, going to our previous slide, you might say, okay, I might have my core 50% and I'll have my 4 initial or 5 initial at 10%, but you can always add more, and then say you build up a little portfolio. So when you first look at the core portion of your portfolio, these are all the assets that will be allocated that are designed to be managed passively. So this is what I'm talking about here. So it doesn't take a lot of time to be watching it. It's instead of trying to beat the market, I am the index. So you're tracking, you're trading in line with the market. So that is what they call the passive involved part of the portfolio. The core can also go along different lines. You know, this can be reflect your bias towards either value or growth. And you'll see in the next slide, we talk about RAFI funds. There's also what they call momentum funds. You might want to have more growth over value. You might have more exposure to government bonds over instead of say corporate bonds. We don't really have corporate bonds, but you might have government bonds over preference shares. You might want to have more exposure to foreign markets versus domestic markets. So, for example, the DBX trackers or the gurus and things like that. You might also want to have some exposure to hard commodities like the metals, like the gold, silver, palladium, copper, etc., even oil. But also, what about the soft commodities, what I call the agriculturals? That would be the wheat and corn. So you might want to have just one basket, one ETP having exposure to a basket of commodities. So the idea is to have a bit of exposure, but whatever you want to prefer, whatever you prefer to create. So as I say, you blend a portfolio for that. For the active managed portfolio, this is the satellites. This is where obviously you want to take advantage of the portfolio manager's skill. Obviously, this will provide the opportunity to earn greater returns than those generated by the core. So remember the objective. The essence of the strategy is cost, portfolio volatility, but also obviously investment return. So those are the 3 things I want to highlight for you guys. When we talk about volatility, volatility is something many investors prefer to avoid. If 50% of your portfolio is tracking the market, and then others are, ideally the satellites should be inverse correlated. So if the SATX 40 goes down, those should be going up and vice versa. So that's what I learned a long time ago is what they call a crocodile approach. So if one goes up, and one goes down, ideally it's a situation where they cross. So you have this crocodile, what I call a crocodile approach, and that's how you want to blend your portfolio. Okay, so this is just a list of the ETFs available. You can see there are 9 ETFs providers. You can see they're all mainly banks. When I say core shares, it's the old Grindrod Bank, but Ashburton is related to the old RMB, Standard Bank, Satrix, Sandlib. So there are 9 ETF providers. And on the ETF side, they've got 57 different products now. So yes, it gets a bit tricky when it comes to their names. So you can see New Gold, New Plats, and New Absa Capital are the biggest in this space. They've got 16 different ETFs. The second biggest after that would be the core shares. They've got 10. And then obviously Satrix, as I say, they've been around the longest. Okay, they've got 9. But it gives you a wide range of different funds and obviously different aspects to look at and things like that. I'm going to go into too much detail today, but different fund, what they do and things like that. I want to give you a quick overview as induction. When we look at exchange traded notes, you can see there's 5 exchange traded providers, and you can see there's 25 ETN products, and you can see most of these are commodities, platinum, silver, and these are exposure to the markets itself. This is Asia as opposed to going to the DBX trackers. This is euro and things like that. So you can build up a nice diverse. If you want to have geopolitical or geographical exposure, you can build up a nice little portfolio just having exposure offshore. And then Standard Bank have a whole range of different commodities. You can see copper, wheat, silver, and things like that. And there's also oil ETN. You see they're the biggest in that space. Standard Bank have more than 10 exchange traded notes. Okay. So guys, I hope that makes sense to you guys. Sorry, I've got a bit of a frog here. Hang on a second. In conclusion, as I say, I want to highlight that ETPs can be seen as building blocks for any share portfolio. Buying a basket of shares or an ETP, for example, ETPs are less risky than buying a single share. So through one share, you have a basket of shares, which is obviously less risky because of diversification. Obviously, also the spread of investment that reduces the risk exposure. They also typically track the index, and these are the most liquid stocks in the market. So again, lessening that exposure to that risk. Indices are regularly balanced, so you're always reflecting the most successful shares on the exchange. So in conclusion, guys, for a novice and this is your call to action for a novice and an advanced investor. This is one way to build a diversified portfolio with low cost and helps you gain exposure to other sectors or geographical diversification. Okay, so if you haven't got an equity account with us yet, this is where I suggest that you click on that little link and you can go register, open up the account, and we can help you with that process. And we've got a whole team of guys to help you there. Any questions you have, drop our email to our wealth@PSG, and there's also our number. Okay, let me see what kind of questions you guys have before ending this off. Okay, let me see. Cool. Okay. Doesn't look like there's any questions there. Okay, there's a question here from Adam Fullion. He hasn't received any of my past webinars. Okay, I'll contact you, Dr. Fullion, to see what you got, what you're outstanding, because I do send them every week. Cool. Okay. Okay, Ken, good question. How much are the fees and commissions? Remember, they trade like a share. So it'd be exactly the same thing like a share. Our minimum brokerage fee works on a sliding scale, 0.9% for your first 25,000, with a minimum of 98 rand per trade. Remember the total expense ratio is all priced in already. Okay, so to answer your question, that is, it's all priced. It's treated like a share. Go onto our website, go look at the fees for shares, and that's exactly the same way. So securities tax and things like that. Obviously, that on the brokerage. Okay. On the yeah, that looks like all the questions, guys. Cool. Pleasure, Doc. Okay. Okay, good question here from Nicole Kotzer. Can you have too much diversification in the ETF? For example, she's referring at the DBX World. The way I look at it, it'd be crazy to have DBX World as well as all the other DBX trackers. So, through one DBX World, you have exposure to all of them, if you want to look at it that way. Alternatively, it's just to decide, okay, I want to have exposure to the US market or to the Europe market, whatever the case might be. So, yeah, it'd be crazy as too much diversification if you're having the same thing replicated. Okay. Let me see a question here. Are any risks in buying ETFs through PSG Online if you already hold unit trusts and shares through PSG Online? No, why would there be any risks? Remember, we are registered by the JSE, registered with FSB, so there's no risk. What's nice about having the ETFs and the shares all in one place and your unit trust is all having one username, one platform. Marius, so I hope that answers your question. Okay, doctor, as you know, I'm not a financial advisor, so what percentage would you put into international? That's up to you. You want to have some exposure. I believe with the rand getting a bit stronger now, maybe it's an advantage to start looking at taking money offshore again. But also remember, we're not talking about taking money offshore. This doesn't affect your offshore allowance, but have a view on the market. Start small and then add to it. That's what I would look at it. So the questions are coming serious, fast and furious now. One can only invest in some of these through ETFs, okay, or are they available? Okay, Colin, good question. Unfortunately, these with the tax-free investment savings account that we have at PSG, at this point in time, they're only the unit trusts, not the ETFs. So, yeah, you'll have exposure through a unit trust with the SATRIX. We're exactly the same thing. But at this point in time, to answer your question, ETFs do not form part of our tax-free investment plan. Okay. Okay. S&P 500 and other diversification, okay, versus DBX World. This is a question from Nicole again. If I remember rightly, the DBX World, if I can just get it quickly again, DBX World was... okay, 1,900 shares worldwide. Okay, so that's the difference between. Nicole, to answer your question, you want to go to the S&P 500. You're having exposure to the top 500 companies in America, whereas DBX World, you're having exposure to the top, or some of 1,900 shares worldwide. So those are the things you have to. Are you going to be concentrated, or you want to be diversified through one share? That's a question you need to ask for yourself. Okay. Which ETFs are weighted by market capitalization and which are not? Good question. Yeah, there are, some of them are weighted, some of them are not. There's one I like that I came across other day. The core shares have a ETF called equally weighted, which the equally weighted top 40. So they put 2.5%. They have 2.5% to each of the shares in the top 40. Okay, that's one way of looking at it. So it gives you a balanced approach, and obviously produces less volatility and obviously less or lower risk to exposure to the top 40. So yeah, it depends what you're looking for. Some might be SWICs where they take out rand hedges where they have less mining exposure. So what I suggest is go look at each individual fund, go research your funds that you're looking at. So that's ways and means of looking at it. Okay, Jan, yes, I'll gladly send you the presentation with all the ETP names and things like that. Okay, cool. Looks like those are all the questions. Okay, that's it. Guys, from my side, thank you very much for being on this webinar. Once again, let me just wrap up quickly. And I appreciate all the questions. As I say, my disclaimer, there wasn't to give you any financial advice. I just wanted to highlight certain funds as an education way to look at it, but please go do your own homework and go do your research on the different funds. And as I say, the main objective is for you to blend a portfolio of ETPs that will meet your investment objectives. Okay, so from my side, thank you very much for being on this webinar. Until next time, all the best. Bye for now.